Anytime there's economic distress, you're gonna see the Fed in the news, and often it's gonna talk about the Fed dealing with interest rates. But it's gonna be really difficult to understand, especially when we're talking about interest rates that don't look like the interest rates that I'm getting on my mortgage or on my car loan. And so in this video, what I wanna do is explain to you what happens when the Fed says it's cutting rates or increasing rates, what that means, how it works, and how it affects you. Hi, I'm Craig and welcome to Market Power, where we look at the power of markets and economics to shape our world. And boy, when the Fed steps in, that is a world-shaping event. What I think is really hard to understand about interest rates is that there are so many things going on in the background. And so what I want to do is simplify this to just this visual metaphor of what's going on in the banking system when the Federal Reserve acts. In my other video about the Fed, I imagined that banks were like vessels of water. So I did a pitcher, and this one we'll do cups. Let's keep that analogy going, and we're gonna keep water as cash. When banks are doing their business throughout the day, they're lending out cash, or people are coming in, taking out their deposits. Whatever the case is, they've got money going out, they have money coming in, and at the end of the day, they have a certain amount of money left in the bank. Now, banks have an incentive to try and lend out as much money as possible because all the money that they lend out is getting interest. Like, that's how banks make money, is by lending out money and getting interest on it. But if the bank lends out too much money and somebody comes to grab a deposit from there, they won't have enough money to give that person who wants their money, and that can be really bad for the bank. And so, to stop banks from lending out all the money that they have, we have a reserve requirement. Basically, that's a line on this cup that says the level of this water at the end of the day must be above this line. It cannot fall below it. But things happen throughout the day. Again, you've got loans, you've got depositors coming and get their stuff. You might not have as many people depositing money into the bank as you thought they were going to. And so at the end of the day, you might fall below that line. What happens in that case? What happens if the bank ends the day below that line? If there's another bank that has money above that line, they might be willing to give that money to the other bank to get them above the line as well. But of course, this is only going to happen if there's a price. And so this actually happens. This is called overnight lending. And that's what the federal funds rate is. The federal funds rate is the interest rate on overnight loans between banks. So you have one bank that has more money than their reserves and the other bank that has fallen below their reserves, and a market emerges, and that bank is able to give money to the other one for a price. When we talk about the Federal Reserve influencing rates, it's this rate that we care about. It's the rate between banks for an overnight loan. Just like any market, this market is governed by the laws of supply and demand. If there is not that much money in the reserve system, if people have lent out too much money, whatever the case is, then the interest rate is going to be high. But if at the end of the day, there are banks that have more reserves than they anticipated, that means supply has shifted out, and that means that the interest rate is going to be lower. And it makes sense, right? If you don't have that much money available and you're worried about falling below the reserve requirement, you're only going to give up your money if you can get a high interest rate. If you don't have that many options to get your money out there, then you're going to be willing to take a lower interest rate. That is how the federal funds rate works, is by the laws of supply and demand. Now let's bring in the Fed. Imagine the Fed wants to lower interest rates. Well, if this is working by supply and demand, what does the Fed need to do to get lower interest rates? That's right, the Fed needs to put more money into the banking system. So it pours money into the banking system to make sure people have enough money to lend to each other and to bring that interest rate down. Now, the Federal Reserve isn't giving money away for free. This is called open market operations. I'm just showing the money going into the banks. What I'm not showing is the things leaving the banks, which are going to be treasury bills most of the time. I talked about that in that other video about the Federal Reserve. I compared these treasury bills to ice. This is open market operations. It's not the Fed just giving out money or printing money and just putting into the system. There's something that's coming out of the system as well. If there's too much money in the system and interest rates are too low, then the Fed will actually take money out of the system. Banks will pour their money into the Fed, and as a result, the Fed will give back treasury bills. And that again is the ice in the other example. But let's just focus on what's going on in the cash market. If interest rates go up, that means the Fed has taken money out of the system. If interest rates are going down, the Fed is putting money into the system. So the federal funds rate is just the rate in between banks. It is not the rate that you're getting when you go and get a mortgage or you go and get a car loan, but they are related. If there's not that much money in the system, that means interest rates are going to be high. And if that's the case, then if I fall below my reserve requirement and I have to borrow from other banks, I'm paying a high interest rate on that loan. That means if I give you money, I'm risking falling into this world where I have to take a high cost loan because I didn't have enough reserves. So I'm only going to lend money to you if it's worth my time. And the way that's worth my time is if you pay a higher interest rate. So if the federal funds rate is high, you have to pay a higher interest rate. Now imagine there's a lot of money in the system and the federal funds rate is low. Well, if I have money at the end of the day, that means I'm just gonna lend it out on this market where I'm not gonna get that high of a return. I would rather get it in another investment that can get me a higher return. And to convince people to come and borrow money from me so I can get a higher return, I'm gonna lower interest rates. I'm gonna give you a better rate on your mortgage, on your car loan, on your student loans, whatever it is, so that way you're convinced to borrow more money, because that's how supply and demand works, right? I lower the interest rate and that increases the quantity demanded. So there's a tie. Now though, something to be sure of, it's not a direct tie. There are a lot of factors that go into the interest rates that you're paying on your mortgages and car loans. But that's what's going on with the federal funds rate and how it comes in and influences the person and the businesses. It's that it can affect the interest rate they get through the interest rates that banks face. And that really is what we need to be focused on. These kind of things are not there to save the banks. The Fed does not go into open market operations to just save banks. They're working because they know that if banks fail, businesses fail, mortgages fail. All these other market situations will fail if the banks fail. And that's why the Fed works through banks, is to help the individual, to help you. And it's important that you realize this is not something there to save banks. We shouldn't be out there opposing it because we think, oh, this is just an intervention to save banks. No, this is an intervention to save you. You are what the Fed worries about. And we should not be in this kind of outrage because we think that we don't understand what's going on. What you should understand, the Fed puts money into the system so that way it can eventually get to you. If you want to understand more about the Federal Reserve or just economic crises in general, I am putting together a playlist up there. But also, if you're tuning into this because you're interested in economics, please subscribe and watch these other videos where we have created a community of people interested in and excited about economics.